Drew Meredith, welcome to this episode of the Australian Investors Podcast.
Good to be here as always. Exciting. Lots happening.
Lots happening in the world of Drew.
there
is
indeed.
a Porsche Macan for sale, if I'm not mistaken.
We love to just tell everyone what type of car I drive at the moment.
Yeah,
Secondhand.
Well, you know
Purchased
what?
from the family.
I was reading a Washington Post article this morning, actually, that showed that Tesla's being sold into the Europe area, which includes like the free trade zones, Europe and the UK. Tesla's year over year in the month of January down 40%.
Not surprising.
Yeah, but the key point is electric vehicles overall
Or broader.
growing
Yeah.
very fast.
Polestars,
Yeah.
BYDs.
SAIC, S-A-I-C, I think that's how you say it.
Yep.
Yeah, massively. So don't know what's going on there, but you did not go with electric in the
I
end.
did not go with electric.
Talk us through your financial
It's been
advisor decision making.
this is one of those kind of long storylines that just continues forever, doesn't it? I've had quite a few photos come through of the 2024 Prado? It's 2025 now. I think it was released last year, but they're calling it a 2025 Prado. So, you know, a big diesel car. My poor 2, 3, and 6-year-old children are sick of hitting their heads trying to get into the current car. So we've had to do a bit of an upgrade and get ready for camping, maybe get a caravan one day. And
Wow, boat.
join the grey nomads.
Yeah.
The boat. I mean, we can always borrow your boat.
You could, yeah.
It's
That thing could throw it around
I
some
know, not
shotgun.
like towing it in your Model Y
Subaru.
Tesla.
I tow with the Subaru and that thing's full of salt now.
Yeah.
So that's not good. But so you did go with the Prado in the end.
It's on its way.
What an
Not on
investment.
its way yet. It's still very broad. They say it's a 4 to 12 month wait time for
Wow.
the car, and they've said it could potentially be here in May. Potentially.
That's pretty hard to plan for.
Very hard to play. We wouldn't want to be not have a car and waiting for this car to arrive.
Yeah. Wow. Okay, so everyone, that's a triple down buy alert for a Toyota Prado 2024 model in what color?
I believe Eclipse Black.
Eclipse Black.
Yeah.
So if you see one of those driving around the streets of Melbourne,
With the
Get your tomatoes.
Deramuth is the number plate.
rates are falling. As an update on the three portfolios, if you're new to the show, we are every week we're checking in with the portfolios that we created at the beginning of 2025. There were 3 of us, and by 3 of us I mean Drew got one, I got one, and the community got a portfolio, each with their own name. The Dizzy Rascals portfolio, which is the community portfolio.
Does this include aftermarket trading on NVIDIA today or not?
No, but you'll be able to fill us in because we are recording this on Thursday, so there's aftermarket trading with the result. Dizzy Rascals, the community portfolio, is showing a grand total of negative 1.44% for the year.
And where's
That's total
Vulcan
return.
Energy sitting on that?
Vulcan is negative 24%. It was negative 27%.
It's not
yesterday
funny for
when I
people who
checked.
hold Vulcan.
Yeah, sorry.
I'm sure someone does.
KKR is in no uncertain terms down 12%. Kev Tui.
That's a big turnaround. That was up
That was-
25%.
Yeah. I think it'll come good.
30% swing.
I've got to,
You're
as the
running
kids
out of
would
days.
say,
There's only a certain number of days in the year.
there is. But as the kids would say, it's a vibe. It's coming back.
It's a
Private
vibe.
equity, everyone's doing it these
I'm not
days.
so confident.
Everything portfolio, named after the eggs for Drew Meredith, is not looking good.
Am I beating?
Oh my God.
Am I beating the Dizzy
Tesla-
Rascals? Oh no,
No. In total, you're down 3.3%.
it'll come back.
Tesla's down 29% for you.
Yeah, and that's in like a week. I think Tesla was down in a week. It's lost
my
$1 trillion.
gosh.
I've been here before. I can't be going well for your G-Gus though. You're leveraged.
Let's have a
You're
look. It's moment of
leveraged your
truth.
S&P 500.
Oh, thank goodness. I'm the only one that's in the positive just. Positive 0.44%. G-Gus is holding its own. It's at 1% up. What's weighing me down? RPM Global, which came out with a result. We should provide an update on that. RPM Global looks like it's going to be
Tesla's down 27%
becoming a
this
pure
month.
software business. What?
Yeah, Tesla's down 27% this month.
Oh, gosh. This is the big thing. I read this article this morning. I think the algorithm picked up on what I was trying to search for. But last night, I was also looking at, I don't know if it was like the upcoming results. I was going to try and tune into their quarterly, most recent quarterly results before the next one. So what I do, just as an FYI to people, is I listen to the previous quarter's conference call before the new one comes out, right before. So it's kind of fresh in my memory what they've been working on.
App that summarizes it for you, isn't there? Quarter or something like that?
Is it?
Yeah, in the US. Maybe we can't get it here.
You can use, there's plenty that do it. You can use Ticker, TIKR, and then you can just put that in ChatGPT. I don't know if they want me to say that, but you can. So there's that. But I actually like to listen to it. I like to hear the questions from the analysts. But Tesla, I don't know, Drew. Like if I just bring it up here in my...
Margin's about to just expand in the next quarter. That's what Elon was telling us.
Good old Elon. So
this is one of those this is where they talk about momentum, and momentum is your friend when it's running. But as soon as momentum turns, stock prices turn incredibly quickly.
Okay, I'm going to give you a bit of pop trivia. Without looking at it right now, you might already have it in front of you. I don't know what's on your computer. Tesla market caps, the total value of the entire Tesla
US
company.
or Australian dollars?
This is in US dollars.
1.5 trillion.
900 billion.
Ooh.
Off by...
It's off a trillion.
Now, I'm going to do the same thing for Ford.
400 billion.
37 billion.
Oh.
So
you're not going to play this game, are you?
It's still 30
Tesla's
times.
30 times bigger than Ford, so it should be.
Yeah, it should.
Got the best technology. You're driving it. It's probably the best electronic. It's like
me driving it. All right.
I don't see you driving a Ford. Did you put Toyota? Why don't we bring Toyota?
What about Ferrari?
How big's Toyota?
How big's Ferrari?
Ferrari even listed?
Yeah, it listed a few years ago. It's in euro dollars.
15 billion.
91 billion.
Oh, that's solid.
It's a great business, though. Yeah. That's the difference.
They play a very different game to Tesla.
Yeah, okay. What's Toyota? I always get confused with those Japanese ticker symbols because it's just
0500 or something.
Close. 7203 is the ticker symbol. If you wanted to make investing more like gambling, just give the ticker symbols numbers.
Yeah.
And make it make no sense whatsoever. So how big do you think... This is in Japanese yen, so I'd have to do a hard conversion here. I can do that on...
300 trillion yen.
Which I have no context. That could be $20 Aussie. 43 trillion yen. So let's convert that yen to USD. So it's in Tesla terms.
50 billion.
That's 0.29. I don't know. It's like 200 billion. I don't know. I'm struggling with live conversions.
400 billion.
400 billion.
Yeah, pretty solid.
Okay, so that's pretty...
Not a bad business.
It's a good business.
I think they were talking about merging Toyota and Honda. Was that last year?
Really?
Two of the big Japanese companies merging.
Interesting.
Because they were struggling for growth.
Honda Co.
Tesla
Here we
isn't
go.
struggling for.
Yeah, Honda's much smaller. 7 trillion Japanese currencies.
We should be traveling there.
What about Suzuki? Suzuki, as a final bit of pop trivia for the show, 3 trillion. If they just all merge together,
they'd be worth almost as much as half of Tesla.
Yeah. Like every car company in the world. I don't know. So you've still got, why did you pick Tesla was it just a pure momentum trade? Is that what it was for everything?
Frothy after Elon, all the billionaires turning up at Trump's inauguration, his role in the Doge committee. But no, I'm also, I think, just electric vehicles.
Yeah.
And the story's still there, and Tesla is still by far the leader in that industry, that sector. And they're still talking about bringing SpaceX and the other businesses into Tesla at some point this year too, aren't they?
Interesting. I did not know that.
I believe so.
I'm not as familiar with the
breaking
business.
news here, so
you heard it here first.
Better delete my X account pretty quickly.
Yeah. Yeah, it's interesting. So the Forbes rich list is going to be updating rapidly with Elon's stake diminishing.
Who really cares?
But you mentioned NVIDIA before, which we should talk about because that's also in your portfolio? Yeah, it is. Yeah, you went heavy on that. That's currently down 4% according to the Novexa.
It was up 4% in aftermarket trading, so I reckon we'll have a little bounce tomorrow.
How much did you say?
It was up, I think, nearly 4% in aftermarket trading, which doesn't really make sense. I don't understand how you can keep trading a stock aftermarket and then it resets itself in the morning. So maybe we'll go through that as a question one day.
Well, I can quickly educate everyone. So basically what happens is the brokers make a market outside of the stock market hours. And so you can have indicative buys and sells. And one of the reasons that this is really important is think about it from the perspective of like an Australian investor who is buying an ETF that is buying NVIDIA stock.
Because the market closes
They
at
use
9 o'clock or 8 o'clock
Yeah.
in Australian time at the moment.
So that what they do is they use something called an indicative net asset value, where they think the stock is going to trade the next day.
Yeah.
That's effectively how they do it. And so aftermarket trading in the US is really important because it probably helps them estimate
Do
what
with
the
the
stock's going to
rest of the
open
world,
up or close down or whatever. So that's that. Yeah, it's actually a really big thing. Okay, so Nvidia, buy, hold, sell.
Buy. I mean, it's long in my portfolio, but it delivered another, I mean, it's not as stunning as it was last quarter, but 100% increase in sales on last year, 115% increase in, or 100% increase in profit on last year. Yeah, it was last quarter, it was 300% growth compared to the previous year. But this is pretty, I mean, you can't even say there's pretty solid numbers. There'd be few companies in the world of any size, more than like a couple of $1 million that would be growing at that speed.
Yeah, well, it's 3.2 trillion in market cap. What's crazy about this business is like we say market cap, it's just the size of the company, but you've got to look at what's underneath. Like how's the profit? Where are the earnings trending? What's the business's potential or not? But so, for example, with this, it's crazy to me to think that Nvidia's gone up. I'll just go the last 5 years, up at 1,800% in just 5 years.
Yeah.
If you go back further, it's just astonishing. But its PE ratio is 50.
Yeah.
Right. Now let's go to
Pretty good comparisons with
Let's go-
50 PE in Australia.
let's go Commonwealth Bank, 27. Would you rather buy Nvidia at 50 or Combank at 27?
Nvidia.
Exactly. So
But not saying Combank's a bad business either.
no. Like it's different part of the portfolio potentially.
But you'd have something like car sales in Australia that trades on a similar, it's 55 times PE for car sales versus 50 times for Nvidia. Car sales is growing maybe 15, 20%. Nvidia is growing 100% every quarter, every year.
yeah, it doesn't need to grow much faster, and that PE ratio becomes from 50 to 20 to 10 if it was just to stand still. So it's easy to see why. But it's a remarkable story with Nvidia.
And everyone has to basically buy more at the moment. No one's caught up with the technology of NVIDIA. So all the new customers that are going to Microsoft, all the new people trying to engage with or integrate AI into their businesses, they're going to Microsoft, who then has to build more data centers which are powered by NVIDIA and some other chips. And that's why things like TSMC and ASML come into the storyline at some point as well.
It's quite interesting because I think I told you just off here, I was just going back and just listening over the last week. Instead of listening to some podcasts, I thought, you know what, I'm just going to go and listen to heaps of quarterly reports just on the commute and in the car and whatever on the planes. And I've just been listening to them all. And literally every one of the Mag 7's like, yeah, it's our own silicon and we've got the full stack and we've got the best AI. If you look at the computation, and it's like, you can't all say the exact same shit at the same time and all be true. It's kind of like early.com where everyone was like, eyeballs, like, who's right?
Yeah.
DeepSeek this, ChatGPT that, Anthropic's, what they doing? Like,
there's some story coming out that DeepSeek actually requires more energy than ChatGPT, but who knows? Like, it's so hard to find information on that.
The interesting thing is I spoke to Billy from
Globlex,
getting confused.
sponsor of the show.
Sponsor of the show, Globlex, Billy. And he was saying and because he's a big tech guy and an investor, and he was saying all the money is not in what DeepSeek's doing, as in trying to train a model that you can do at scale. DeepSeek's kind of proven that for a lower cost. But the real thing is the inference, which is where all the money's being spent now. It's how do you have complex data sets that then the model can learn from,
analyze and
then regurgitate something interesting. That's where the money's being spent right now, not on the original training. That was a few years ago. And so it's been really interesting. It was also interesting to hear the other AI kind of CEOs respond to DeepSeek in real time, like Sundar Pichai from Google/Alphabet was they're obviously, he acknowledged that they're obviously super talented.
Yeah.
And they've been able to accomplish something on the training side with just super smart people with probably suboptimal chips. You speak of NVIDIA, they didn't have that.
Yeah.
So they had to overcome that with lesser technology to build something quite interesting. Bringing it closer to home though, Drew, there is something here around Magellan versus Platinum. And then there's a little note here that says in disarray.
Which one?
For
Magellan got a payment from Barrenjoey, didn't they? They got their first dividend.
Just for everyone's benefit, over the last 2 or 3 years,
We don't have to talk
We've
about
been
this one
having a
anymore.
long bet about whether Magellan or Platinum. Drew has repeatedly double, triple, quadrupled down on Platinum. I've kind of maintained that Magellan with Baron Joey and just the Airlie funds management and just their, to be honest, just their general business.
We do not
is
hold
pretty
either of
good.
these stocks. Let's be
Yes,
clear.
I do not hold Magellan.
Or recommend.
Yes, that is correct. Although I did cover it last year for our
You'd be
members.
surprised though.
What? About what? I mean, they're both,
Who's
Yikes.
done better so far this year?
well, Magellan's fallen off a cliff. Sorry, guys. But it's true to say 24% stock is down. This is not the fund, by the way. This is what people get
The fund
confused
manager.
between Magellan and Platinum as companies versus the actual funds that you may be invested in. To be honest, they're going fine. It's actually just the stock that we're talking about of the overall company. Magellan's down 24%. Platinum, which trades on ticker symbol PTM, is down 18. So Drew has pipped me, but it does look
it's
like
a race to the bottom. It's not a race you want to be.
Well,
you don't want a
according-
horse in this race.
According to the overlord that is Google Finance, Platinum currently, Drew, is trading on a 17% dividend yield. Dividend trap, yay or nay?
Yay.
Okay. Wowza.
Dude, this is what people don't really necessarily realize a lot of the time is that dividend looks attractive buying today, but it's usually due to the fact that in this case, their assets under management are falling, which means their performance fees and their fees are going to be lower in the next quarter, which means their dividend is not going to be at the same level.
Yep.
This is like not saying that it is a dividend trap and that it will 100% happen, but that is what usually happens.
Yeah, as a quick rule of thumb, don't just look at Google Finance or don't just look at like what's in your brokerage account. If you can, even though it's still not great, is just look at the analyst estimates. So you can go into some platforms like Selfwealth have it in if you pay for the data package. ComSec have it if you pay for the data package, I think. You can just sign up for Ticker, TIKR. They have great analyst forecasts, and you can just go in and see what is next year's dividend according to forecasts. That's a better measure than just chucking it in Google and getting last year's dividend, because you might end up with something that doesn't even pay a dividend. That's a mistake people make.
A little hark back to the pandemic here too with the PointsBet. Have you seen that?
Oh, I don't follow PointsBet that. To be honest, I don't follow any of the gaming stocks
yeah.
that closely.
I thought this was more of a story of what can happen during, not call it a mania, but bubbles that occur. So PointsBet, Shaquille O'Neal was the spokesperson.
Paid him a truckload of
Paid him a
money.
lot of money. Shaquille O'Neal, for those people who don't know, is one of the greatest basketball players of all time, 7'2",
Big boy.
huge. But that has nothing to do with this. But
Just a random fact.
yeah, just more. Yeah,
He's a
sorry,
big guy.
I'm laughing a lot today. I have to apologise. We had a week off.
Yeah, we've got a comment about that.
Yeah. So PointsBet just this week rocketed by 30%, moved 30% higher to a total share price of $1.10. Why does this matter? Because in the pandemic, this was one of the most popular companies in the world because US opened up gambling, sports betting. It peaked at a share price of $15 per share. So the takeover offer is, I'm just going to assume it's like 95% below its peak.
Currently
Only
$1.11.
3 or 4 years ago.
This is, I don't know, again, we're trusting Google here with some knowledge, but in 2021, Drew, PointsBet traded at $15 a share. It's now $1.10.
And this is one of those things. Whenever we see a lot of people, you're probably going to start seeing a lot of people who come in with direct shareholdings that they've had for a long time.
Yep.
And there's this anchoring bias that happens if you bought PointsBet even at something like $10 and it's been trading below it, in 50, 60, 70 cents, you're, for some reason, as humans, we're all anchored to this idea that it'll get back to $10 and we'll sell it then. But what tends to happen is either the company disappears or takeovers like this happen where you're getting crystallized at a lower point where you most likely could have reallocated that money somewhere else 2 years ago and done significantly better than this 30% pop that's happened 3 years after the fact.
In your experience, does someone in this situation, if they held PointsBet, say, for example,
Yep.
And they do get a takeover like this,
The best thing that can happen sometimes because
it forces them to make a decision.
Yeah, now you can just
then
move on.
and then you don't have to make the decision.
You're not anchored by it anymore. Like we could recommend selling this and it'd be, it's sunk costs already gone, but you still could have done something else with that money in the last 2 or 3 years.
Drew did make a passing comment about laughing because we did get, this has nothing to do with
quite
me.
common.
This is all about James and Drew over on the retirement podcast.
You put yourself out there, this is what
This
happens.
is one of the best comments on YouTube from the week because we sometimes do share.
Was that fresh from this week?
This when I sent you the screenshot, it was 8 hours before that. So
reckon
it
this-
was like 2 days ago.
I reckon there's one a week.
that is just like makes you giggle.
Yeah.
So this one here was from YouTube. So shout out to this person on YouTube that left a comment on our retirement podcast, which was building wealth in the lead up to retirement. Great episode, by the way, if you haven't checked it out. And they say, quote, informative podcast. It would have been more helpful if you could laugh less. End quote.
Don't listen to these in Australian Investors podcast.
So good. The fact that it made us laugh was just the irony, and it's fantastic.
And
keep the
there's something
comments
about
coming.
Mary Louise Walsh or something on there.
Oh yeah, there's another one here, which was this one comes from Dr. Harris George on YouTube. I will forever be grateful to you. You changed my entire life, and I will continue to preach on your behalf for the whole world to hear you saved me from huge financial debt with just a small investment. Thank you, Lisa Mary Walsh. Now, if you're wondering what this is all about, it's a pure spam comment. And then they thread that with about 20 other comments referring to Lisa Mary Walsh. And you know it's a scam because ultimately at the end it has a WhatsApp phone number.
Message me on Discord or WhatsApp or whatever it is.
Whoever you are, Lisa.
Follow these comments. We do our best when we've got our own channels, but I think we moderate our channels ourselves.
Yes.
To delete those comments as quickly as we can, but it's impossible to keep
There's
up.
so many of them. And there's another one here which is good from a rando handle on YouTube. Super, super, and more super. For God's sakes, it's the best tax avoidance you can get for the average worker. End quote. That was actually a pretty informative, solid summary of a podcast episode on super.
For sure. just take that advice. That's all you need.
Yeah, don't even listen to us.
On.
And actually, there's another message in here from Drew Meredith. It says, Sumba Island Resort. What's that all about? Anyway.
We'll find out. Maybe a live episode.
Maybe from Sumba.
Yeah.
UniSuper entering financial advice.
That was actually, they're already in financial advice.
Yeah, because they
got an internal advice team, but they actually launched digital advice.
Yeah, there's a couple of them roll this off recently.
The interesting thing here is that the digital advice would only let you choose your investment option or help you choose your investment option on UniSuper.
Oh, so they made a big buzz out of nothing.
And eventually they said that'll expand into contributions, pension commencements and those sort of things, but their digital option via not Ativo, Ignition.
Oh, Ignition Wealth. Yeah. Okay. Yeah.
Is launching. So it's came at the same time, and I'm doing an episode with Beck Wilson from Epic Retirement on this as well, which is those changes the leaked changes to retirement income in Australia, which I think you're seeing a lot of interest and buzz around, a lot of changes.
That's
going
where
on super funds.
The government's basically dictating that you have to take your retirement income in a prescribed way.
Essentially, it's going to force, I don't think it'll ever be passed in the way it is. We could fearmonger and say, yeah, you should do all these things, but I don't think it'll ever be passed the way they're talking about it. But it's essentially they'd force every super fund to buy annuities and become longevity insurance versus market linked.
Allowing people to just pull their money out in one go.
So it becomes a quasi-defined benefit super fund, super industry, compared to a defined contribution, which we have. And there's a whole reason we stopped being a defined benefit. It's because it was sending the government broke.
Yeah. Just look at Detroit.
All the major companies were going broke.
So basically, so what Drew's saying is that in super, there is an instance where some people, particularly with lower balances, they tend to just, as soon as they can access super, pull it all out.
Yeah.
Which then obviously defeats the purpose of trying to protect people for income in retirement and the government.
Then you've got the other end where people aren't spending enough.
And they've got too much. So that's why you have the minimum withdrawal amounts in your super, where you have to take a percentage every year, because some people don't need to take the full percentage, but the government makes them do it. And then a lot of people, Drew, just take that 4% or that 6% and then just put it in a different investment account and they just pay the tax. But yeah, this is basically saying for folks that are at the lower end, and these two
it's
ideas.
For folks on the higher end, over 200,000 was the idea.
Oh, right, okay.
So basically anyone.
Oh, of course, yeah, of course. But this is quite interesting. The 2 points that you just raised is, one is you're saying like there's more super funds trying to be active in advice, which we know has been happening for like 5 years. So if you've got a super fund, they may be able to offer you financial advice. It's like piecemeal, like small amounts for cheaper prices. But interestingly, the other part, which is the constant rule changes around super, is that the big super funds want to get in on the financial advice action as much as possible.
Yeah.
We see this across the board. And hopefully that means that for the masses of Australia, if you don't have the full amount of super, you can get full amount of wealth that you want, you can go to your super fund and get some advice rather than paying 5 or 10 grand to see an independent advisor, like an advisor that's independent of the super fund, and getting help that way. So that's a good thing.
I think it's going to be incredibly difficult. Like essentially what we have in Australia is super funds that are fund managers that they have, Australian Super has 1,300 employees. I'd suggest more than 70% of those are investment admin related versus member facing.
Yep.
So it becomes incredibly difficult you work with 2.3 million members. You're going to have a
lot of
massive team of consumer facing people, and that's expensive. So it's going to be interesting to see this, and I know we'll be talking about it this afternoon on the retirement podcast. But it so much comes down to continue to give people choice and personal choice, and making sure that there's options. No retirement's the same. There's no cookie cutter retirement. So how do you make sure people can find the options that are best suited to them?
Yeah, definitely. And if you do have a bit more money, you probably do want to seek advice outside of your super fund anyway. And I'll give you a big reason why. Is because a lot of times that super fund wants to give you advice on the super fund.
Yeah.
So you probably want someone else to give you a second, broader opinion. Other news, WiseTech.
We did an episode on this earlier this year, I believe.
Avoid the headlines.
Yeah.
No defamation. WiseTech down under $100 a share for folks that are hungry for a bargain. I've had quite a few people in the community talk about this. WiseTech hasn't traded at these levels since, less than a year ago. WiseTech is a global software business that provides its software for ports and for freight forwarding and for logistics industry. And it's a wonderful business model, absolutely stupendously wonderful. One of the best tech companies in Australia. Have had a few issues recently at the board and CEO level, PR-wise, a few things. You can Google it yourself. But a lot of our community, Drew, are asking, is now an easier time to buy some shares of WiseTech? Very expensive in every traditional valuation metric. I want to make that known. Hugely volatile company as well. I would say it's one of the most impressive business models on the ASX. I got to admit, without going truly deep into the valuation here on the show, because it probably wouldn't make a lot of sense using conventional
120 times PE, yeah.
Discounted cash flow, dividend models. It just doesn't make sense from those perspectives. Even you just mentioned the price earnings
almost
ratio.
as big as Suzuki.
Yeah. I'd rather buy this than Suzuki, I tell you what. I got a Suzuki engine on the boat, that's pretty good. Anyway, I was thinking about this the other day. I was like, it probably doesn't make a lot of sense on a valuation perspective, but I would probably just happily nibble at these levels. Like just have a little allocation. If it goes up, great. If it keeps falling, you could just keep nibbling. I would happily allocate to this business as obviously a part of a satellite allocation because it's an individual stock. It's going to be a bit more volatile. But alongside a core portfolio, I'd be quite happy with this at this level.
I still find whenever there's events like this happening, so they've had 3 directors quit, the founders come back in after some personal issues, the founder, executive chairman, yep. I'm always like, wait, like not if there's smoke, that's probably not a good one, but it's
smoke
like
and mirrors.
How are the biggest, like the people, where there's smoke, there's fire, you never know where the focus is. And I think fund managers will talk about this, but the most important thing for these companies is their relationship with brokers and fund managers and who's buying and who's confident with the business. So understanding where that sits. If one of the big fund managers that's invested in WiseTech decides to cut them from their portfolio on governance concerns, that could hurt the short term, could hurt the share price in the short term.
Yeah.
And I'm always like, just pause, don't jump right in. So, or what you're doing is nibble. Don't be going hard on it.
Yeah, you just take a small position, you take a little bit more of a small position.
Yeah.
Was it Peter Lynch who said, buy a company even a monkey could run? I don't know.
What are you saying?
Well, Pat Dorsey, who was the head of research at Morningstar, then founded Dorsey Asset Management, he said it slightly differently. He said, if you have to bet on the horse or the jockey, take the horse. And I think that is true with WiseTech. So in the sense that WiseTech, the company, is the horse, in that it is such positive momentum. It's a software business. It charges a fee based on how much usage goes through the platform. And once this software is embedded in ports, customs agencies, freight forwarding, logistics, like good luck to anyone trying to rip that out. So I would, this is why I say it's a nibble and not like a full allocation. And full allocation might be management, everything's in line.
Yeah.
Expect volatility, but I actually think it's a wonderful business. It's not quite SAP-like retention, but it's
very similar. There's no real competitors.
Good. Yeah.
I mean, Richard White did come out and say his clients, the customers do not care what he's doing. like personally what he's doing. They
Yeah.
actually do not care. The software must be that integrated in their business. Not like a cloud that you can just swap between others.
Yeah,
but
go from Azure
actually
to
central to running their business. So
Yeah. I actually think it's a really good business. Let's just say that. Business, I think it's a wonderful business. I passed up on it at $20 because I said it's too expensive. What did it go to recently? $130. Expensive, yes. Small allocation, nibble. That's it. That's all I got. In a similar vein, I was listening to the Costco. I'm going to give you some trivia. Costco most recent quarterly announcement. I was tuning in. Not
been
their
meaning to go to
recent
Costco as well.
Yeah, I don't do a lot of shopping at Costco, but when I'm there, I always leave feeling good about myself. But then I also get home and I'm like, I just spent like $1,000 on stuff I didn't need.
I got a trailer full of stuff.
Yeah,
Who needs $100 of toilet paper and 3 kilos of prawns?
48 lamb cutlets the other day. I was like,
Australia Day.
Sarah will eat these.
Yeah.
They're pretty good.
48. You were cooking them a week.
That's what they came in. There's 48 of them. So anyway, it was $90 a packet.
Sorry for all laughing today, for all the YouTube listeners.
But interestingly, what do you reckon? So you have to buy a membership to shop at Costco.
Yep.
What do you reckon is the retention rate of a Costco member?
100%.
Not quite. It's not about 92%.
That's pretty good.
Now, if
it's only $50 or something, isn't it?
Yeah, it was 60. I think they've got like an executive level. I don't even know. Let's be honest. But the thing is that's really interesting. If this was like a technology investor trying to do some spreadsheet gymnastics, what they would do is they would take that 90%, invert it, and effectively say that there's a customer lifetime of 10 years.
Yeah.
If you did the same, if they got their retention rate to 90%, 95%, it's a 20-year customer lifetime. That's what the math basically says. Joe Mager, formerly of Lakehouse Capital, did a really good article on that, by the way, if you want to Google it. What I mean to say is the amount of loyalty that's embedded in Costco is unbelievable.
Yeah.
No one cares if you shop at Coles or Woolies, let's be honest.
I think once you start going to Costco, you don't.
Yeah, if you've got a big family, you just keep going.
Yeah.
And you get a hot dog. It's kind of like
the whole day out.
Yeah. But I think it's a really interesting business model. And Costco makes basically all of its money from the membership. And
all of its money or of its profit?
All of its profit, sorry. Yeah. A lot of its sales come from the actual products. But
so like to make 7% margin, and it's from memberships, not
exactly.
from...
And everything else is just reinvested into lowering prices.
Yeah.
Which is, when you think about that, it's kind of like Amazon-esque. Like the business model is actually just purely for the customer. But I have this kind of view, Drew, and everyone can disagree with me on this or kind of just nod your head, is I reckon these kind of big warehouse type things, where I think in the next 5 to 10 years, they're going to become way more valuable to the business owner than at any time in history. I think these big distribution centers will become multi-purpose distribution centers.
Yeah.
And we're starting to see this. If you go into like my local Woolies or Coles, most of the people buying stuff off the shelves or picking stuff off the shelves are people packing online orders.
Yeah.
And you can't do that.
You can't even get through this
without a store.
You can't get through their shopping, like through my local Woolies, without running into someone,
exactly.
an employee with
with
a trolley.
A green apron on, like packing some boxes. And another thing on that is, I was like, oh no, Amazon's just going to smoke Costco. Like this thing is done a few years ago.
Yeah.
Obviously, I was proven wrong. We'll get to that in a minute. Costco's foot traffic per stores is up massively. Like every year, it's up 5 or 6%. But over 10 years, foot traffic to Costco's globally are just amazing. And I'm like, well, that is directly in opposition of what I thought was going to happen.
They're just a bit far out of the way in Australia, aren't they?
Yeah, but that is really exciting to me because then I'm like, they've got a huge runway, not just in the States, but they're also big in Japan now. They're finally, for the first time ever, launched like in earnest a Costco online service, which makes a lot of sense for businesses because you can buy in bulk, your office. Anyway, whole point of this, here's the trivia.
There was a question.
2 questions. How much is Costco up over the last 5 years? In just stock. US dollars, it's
300%.
That's a bloody good guess. 270%.
Yeah.
Second question.
Solid business.
What's the market cap of Costco?
Or will be like
US dollars.
600 billion.
Not far off. 460 billion.
Better than usual.
And PE ratio?
22 times.
61.
61. Oh, yeah. We did
People
meet,
are treating this like a growth stock.
yeah.
This is higher than
That's
NVIDIA.
what someone was saying about, I met Jim Clark from Brandywine. So massive, he was talking about, this was Walmart he was talking about, which is actually the biggest retailer in the world, I think. And also the creator.
Actually just got overtaken by Amazon like in the last quarter.
Did it?
Yeah. But it would be second biggest. Yeah.
And he was saying exactly the same thing, but that Walmart wasn't showing the same level of growth as Costco was, and that it was being treated like a tech stock. And then the next day, Walmart fell 20%. I mean,
Interesting.
I think he's been saying that story for a while, so it's going to happen eventually. Yeah. But it's interesting what kind of multiples are going on very consumer staple, mature growth businesses.
Sam's Warehouse, which is the one that's owned by Walmart, that is using similar types of
memberships.
Memberships and checkout experiences and that sort of stuff as Costco, but it's buried deep within Walmart, which is a $700 or $800 billion business. Anyway, fascinating stuff. We should probably answer some questions.
You had some big news this week, though.
I think. Yeah, well, to be honest, I wasn't going to tell the podcast about that, but I can announce it. Yeah,
we're getting some comments, so.
Yeah, fair enough. We are getting comments. So we launched Rask Advice in the past week. It was a soft launch, Drew. So obviously, Wattle Partners is a massive partner of ours here at Rask, and a lot of people are connected with Drew, Jamie, and the team at Wattle Partners through the Rask network for retirement advice. Just likewise where we have with James at Northeast and Everest in the accumulation stage of people's lives. But to be honest, we've got so many people that come to us for financial advice that all of us can't keep up. So what was fascinating, Drew, I went into Seek because we had a job listing recently, and the top 8 job listings in Seek for Victoria were Northeast, Sky, which does a lot of our insurance. There's one for Rask. Everest had 2. And then you guys hired recently as well.
Yeah, we use Recruiter.
Yeah. And I was just like, it's clear like there's
a shortage.
Modern financial advice businesses are just like, if you want to work at a great place for financial advice, just go for a job at any of the ones that I just mentioned, and you will have a great time. And so we've launched that. We begin giving the actual advice. We've made hires already, but we'll begin giving the actual advice late March, early April.
Beautiful.
But yeah, it's, you would know because we did that financial planning giveaway in January.
And it was 300.
510.
510, not 300.
510 groups.
And that was mostly people who we said will be willing to be on a podcast, let alone the ones that wouldn't be.
Yes. So that was just from one podcast channel. Yeah. 550 people came forward, or 510, came forward to win advice from you and James. And that was just on the retirement podcast.
That was crazy. I mean, I wouldn't say well done getting to that point because it's been getting your own license, going through the training, putting all that kind of framework together. And I know there's been comments on all the community and all that, which like there's no bad blood between anyone.
Yeah,
so I see it as a positive, as kind of people who have been in the industry. I mean, I've been in the industry for 20 years. The more people that come into the industry and help bring more efficient, more cost-effective advice, and similar to super funds, there's no advisor that's perfect for everyone. So it's more welcoming more people, having more choice, I think is just positive.
Yeah. And it's great. So thank you, mate. And thank you for the support to you and Jamie in particular. And I think that's probably a key thing to understand is actually James from Northeast Wealth came to me in October and he's like, mate, you sent me, as in Rask, sent me so many customers last month. There is absolutely no way we were ever going to keep up with that. You need to do something about it. And I was like, So then we launched Money Coaching.
Merry Christmas.
And then in the first week of Money Coaching, I think 20 people came through from Money Coaching the first week. And then it's just grown. So yeah, it's wonderful, but it's it's been a slog. Financial planning, you've told me this a dozen times this morning, it's not straightforward.
They're one of the hardest businesses to run.
Yeah. And you mentioned before, like even for example, if you're listening to this, you're like, what are these guys talking about? If you think about it, like everyone that comes through the podcast and chats with us has their own view on WiseTech, their own theory about property. They read something in the AFR for some geezer and everyone's got an opinion. And so that is 100% is what we want because we want you to be informed. But when you see a financial advisor, they're trying to be as objective as possible. And that means that every person that walks through a door has to be treated uniquely.
Yeah.
There's some principles and whatever, and that's just a very different experience. So, I'm excited, mate.
And it would be one of the industries with the most compliance hurdles, registrations, fees in the world. I wouldn't surprise me if in the world. Like there's every quarter there's some sort of new registration we have to do or payment we have to make to the regulator. Let alone the state. Talking people through a statement of advice, which a concise version is 50 pages. Yeah, and you have to provide that to provide personal advice to people. Hopefully, there's change in the next few years.
Yes, but it's exciting. So you can find out more. I'll put a link in the show notes to that. The reason that I wasn't going to mention it this week, Drew.
I put you into it. I like being able to put you offside for once.
Yeah, the reason I wasn't going to mention it is because we've had so much, and it's not just
you
us.
Wanted to slow it down.
I wanted to slow it down. But no, I'm glad you did, and I'm very proud of it. It's just, it's just a lot. So we're still just scaling up, and it's going to be challenging but exciting.
And you've got a baby on the way.
And I've got a baby on the way. So there's in the middle of all that, there's just going to be a bomb drop somewhere in between trying to...
A cute bomb.
A cute one, a little love bomb.
Yeah.
In the middle of it all. We got time for questions. Let's get some questions now.
Some, maybe one.
Okay, so we've got a couple of good ones to kind of wrap them up together. So if you do get your question on the show, we love that. Please write into us. There is a link in your YouTube description or in the podcast player. You get your question on the show, you'll get something for free. Have a bit of fun. Give us a funny name. We don't know your needs, goals, or objectives. So any of the information that we deliver on at Rask Podcast is strictly general in nature. If you don't know what that means, you can head to the Rask Group's Financial Services Guide, found at rask.com.au/FSG for Financial Services Guide. If you do think that you're going to act on this information, always read the product disclosure statement of a PDS or a super fund. Actually, never change super funds until you've spoken with your advisor or reviewed your insurance. If you want a financial advisor, you can find a link, as we've said, in your podcast player or YouTube description. First question comes from Decentral Eyes, as in EYES, eyes. Given that there is a developing trend towards economic decentralization from the US and the US dollar, this is actually very interesting, how should long-term investors approach diversifying their core equity portfolios by increasing exposure to developed and emerging markets outside the US? For example, adding an all-world ex-US ETF? Is this a smart hedge against shifting economic power, or are we just chasing the next shiny thing? Like that one friend who insists on ordering the most quote-unquote authentic dish at a restaurant but always ends up regretting it. That's a wonderful question. Maybe I'll go first, Drew. So
it's difficult.
It's hard. We love a zeitgeist here at the Australian Investors Podcast, but we do not know what Donald Trump or his wingman Elon Musk is going to say tomorrow. So realistically, we are just trying to be mindful that things could change. And something really interesting happened to me on the Monash Freeway the other day, other than being stuck in traffic, which is always interesting. I was sitting there, and I sound like such a wanker when I say the story, Adrian.
In your Tesla.
I was sitting there in my Tesla, just driving along, and there was a BYD in front of me, Beyond Your Dreams. It's a Chinese electric vehicle. But on the left of me was one of those brand new BYD Utes, and it looked really good. And I was thinking about this. If you look across all product sets around now, you've got strong competition in auto. You've got things like TikTok competing against Facebook. You've got DeepSeek competing against ChatGPT. You've got Huawei in phones. I don't use one of those things, but if you did, And so you see it is really pervasive in your life that more and more products have serious alternatives. And to be honest, for humanity's sake, it's probably a good thing to have competition.
For sure.
But at the same time, how does an investor deal with that? I think you can't disregard what's happening throughout Asia, to be honest.
Yeah.
But you also can't disregard American exceptionalism. So you have a bit of both. There's a bit of a property rights fiasco when it comes to investors. Like capitalism is built on the idea that if you build something, you own it.
Yeah. And it can't be stolen.
Yes.
Or can be protected.
Yes. But that is not as popular of a concept in the East. So basically, we still tilt our portfolios towards US companies because you have that kind of protection, and there's a very good working relationship, obviously, between Australia and the US.
This thing comes up all the time.
Yeah.
Not the deglobalization, but the the US dollar no longer being the global reserve currency.
Yeah, debasement.
And I think, debasement of the US dollar. And I see that like these are kind of pipe dreams, to be honest. Very little is going to change to the point the US dollar won't be the most important currency in the world. And I can be quoted on that, hopefully. Rates did fall. We missed an episode last week, but I won't go into that now.
Yes.
I think, but this is a story of what you should always be doing. Like it's not just about this one theme, decentralization from the US. I think it's the importance of always looking for resilience when you're investing. And there's different ways to do it. The US is still going to be the home to the most important companies in the world for at least the next 10 or 20 years. Who knows what happens between then and now. But it also shows, and I thought this was interesting for the start of 2025, that active managers have outperformed the index. 53% of active managers have outperformed the index in the first 2 months of 2025. So we know the data shows that like 90% of active managers underperform over the long term, but it reminds you that over short periods, active management can definitely outperform the benchmark. So I think how do you get away from the US? One part of that is by using ETFs that go into other parts of the world, but another part is also using active management along with passive management to help have different exposures than what's happening in the S&P 500. And that can help you go into places like Asia, like Europe, probably the two most important regions outside of the US.
Yeah, you don't need to go, straight to the most authentic curry.
Yeah.
You can have a bit of a mix and at different times.
Exactly.
Yeah. You often say on the show, I'll put some words in your mouth, don't prepare for a given future, prepare for any future.
Multiple, yeah.
Yeah, and I think that's really apt when it comes to these big, overwhelming geopolitical question marks that people have, is just not going out there and putting all of your portfolio in crypto. That was a great idea for people that got it right, but you could have got it totally wrong.
Incredibly wrong. I keep getting that question at home too.
But
why aren't we buying crypto?
I got to catch up with Cameron Gleeson from BetaShares this afternoon to talk about this. Is having 1% of your portfolio in Bitcoin because you believe in the debasement of the US dollar, sure. Or having 5% of your money in Chinese A shares, sure. I might have some issues around, whether that money is there or not, but not
all of it. Yeah, exactly.
And I think this is where it pays to pay attention, but at the same time, remember, we're not just building portfolios in shares either. You can go and buy a property. You can put money in the bank.
Bonds, infrastructure.
You mentioned active versus passive. In bonds, that narrative is the opposite. Active bond managers do better than passive bond managers. So it's just about being aware of all those things.
And not just betting it all on one.
Yeah. And there's one final question we might have time for today, Drew. Sorry that we've run out of time for too many questions this week.
Too much laughing.
Too much laughing. Let us know about the laughing. We didn't bring any golf talk into it this week. We did actually have Nehemiah Richardson from Term Plus last week. He did start by, I prompted him on a Kapalua golf course. Looks incredible.
Hawaii or?
Yeah. Kapalua is like, it's something out of a fairy tale. And I didn't even get into golf. Investor Gadget wrote in with an emoji as well. Extra points for that. Long time listener, but still learning. That's great. Aren't we all? My question is, at what point should you sell a stock? If the business is doing great, but has a huge price ticket, for example, $296 a share.
What would that be?
I'm trying to think.
Meta or?
Can it really go up much further? So first of all, Drew, what's the difference between a share price, the number?
This is difficult.
And the business. I'm going to try and figure out what
I think you got to break, I think for newer people, there's this idea that every share was worth the same thing when it listed, so that they're comparable to each other. But the only way you can actually compare the value or relative value is based on the things like what we use, which is a price earnings multiple or, a cash flow multiple or revenue multiple or a price to book or a intrinsic value.
Some valuation.
Yeah, and that'll probably be way too complex. But I think what you need to look for in this business is what sort of multiple is it trading at? So if it's a tech company, is it trading at a 30, 40, 50 times price to earnings? And then what are similar companies trading at? And then how do you feel about the prospects of this going forward? There's other resources. You go and find research that looks into the company and why it's valued the way it is. But just looking at the share price tells you zero about the value of that company.
Yeah. Yeah, because you could have, and I love the pizza analogy here. If you buy a pizza and it's $20, you cut it in half, it's $10 each slice. But if you cut it in 10 different ways, it's a different share price, but it's the same pizza.
Yep.
So the price of it doesn't tell you much. But interesting, I was just trying to Google to find out what this was. It could have been CSL, could have been Apple, potentially Tesla. It's about 290, or it could even have been Cochlear. Cochlear just fell from $300 down to $265. I think Cochlear is a wonderful business. I think this may actually be what I don't know. I don't have a clue, but it could actually be Cochlear. I would just look at the business. Long-term investing is about having an understanding of what it is that you own. The next step you could go is, why do you own it? For Cochlear, it's obviously got implantable hearing aids. Wonderful, wonderful business.
Strong market share, consistent growth.
Reinvest in tech.
Because what you're paying for when you buy these
CSL.
businesses is the future earnings of that business. And if it's expensive, you're paying more for each dollar of future earnings.
I think the thing that people underestimate with Cochlear, and the reason why it gets, like, I just had a big sell-off recently, the reason that we see so much volatility in Cochlear share price is because people have unrealistic expectations.
Yeah.
To actually get a Cochlear device implanted in your head, you have to see an audiologist. That the surgeon has to be trained and give you time to get it in your head. Second of all, is you need to sort out your insurance. So the insurance is actually what normally pays for these $20,000 implants, sometimes more, a lot more. And if the insurance doesn't pay for it, the consumer has to pay for it, or if they've got some sort of government arrangement. So this is a business that is a wonderful business, but it is constrained by what it actually can input into people's heads, so to speak. So if that's the business that we're talking about, I would be looking at what's the runway for growth? How much is it reinvesting? Does it have good cash flow? Like if you go into the annual report, and all of those things, in my opinion, point positively for Cochlear. Apple, I didn't realize because I sold that a couple of years ago. I should have held on to it. Damn it. It's up, 300% if you include dividends in 5 years. I think I sold it a long time ago, which I'm sad about. Drew, we are eagerly awaiting your dad joke, which I would...
Ready to go.
Okay.
And it's going to be a cracker.
As for questions this week, Investor Gadget, we didn't get to a couple of questions, and that's my bad, so I will call them out. Decentralize, great question. Mr. Worldwide, another great one, great name too. Investor Gadget, Rasking for Trouble, asked about core ETF portfolios. We can answer that next week, but you get something too. Bummer, I love free books, Drew, wrote in.
More than happy. So yes, the rates did get cut finally, and there was another announcement today from one of the governors. It isn't me. I was saying I'd give everyone a free book if it weren't cut before Easter.
Yep.
But I'm happy to give out 10 free books for anyone that writes for these questioners or anyone that writes
10 free books. There you go. It's up for grabs.
Through an email
so, and for next week then, because there's only 5 here, Investor Gadget, Rasking for Trouble, Bummer, I Love Free Books, Decentralize, and Mr. Worldwide. That means we've got 4 left for next week.
Yeah.
So send us in your questions. We'll read them out next week and you will get a book. Drew, take us off into the sunset. Actually, before we do that, if you want financial advice, reach out to Drew here at Wattle Partners. You'll find links in the show notes. You can also subscribe to the series, leave us a review, or if you're on YouTube, just heckle us about the amount of laughing that we do, because you'll probably get your heckle read out next week.
We're going to do one episode that's just on reading YouTube comments.
The comments from YouTube. We think that'd be great material.
All right. I had a date last night and it was perfect. Tomorrow, I'll have a fig.
Oh, gosh. What a joke. I'll give you a set.
Well, it is fig season. If you go out, there's a fig tree in the neighbourhood. There's figs ripening everywhere. Anyone that's
There's a season for everything.
Yeah, they're falling over the fence at the moment.
7 out of 10.
Oh, I'll take that.
Because you're tired of it.
You didn't know where that was going either.
No, I had no idea. Yeah. But mate, as always, pleasure.
Good to see you.
Thanks for watching this video on the RAS Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.